Aloha, welcome back to Chapter 11 on corporations. We have the accounting equation here, and I have some of the main T accounts that we use in working through transactions in this chapter. And I just want to spend a little bit of time going through each of these accounts and talking about the types of transactions that would generally be recorded in each of these various corporation accounts. You might notice that 3 of the accounts are colored red, which means they are standard credit balance equity accounts. But there are a couple of accounts, treasury stock and dividends, that are blue colored accounts, which means that they are debit balance accounts. They carry the opposite balance normally found for equity accounts. Again, the accounting equation, I use colors to denote whether an account is typically a debit account or a credit account. The debit accounts are typically the asset and expense accounts on either side of the equation, and the 3 categories in the middle, liabilities, equity, and revenue, are red, and I use red to signify credit balance accounts. Keeping in mind, debits and credits for each and every transaction, as well as in total, must always be equal or in balance. Anyway, getting back to our accounts, one of the main accounts in the equity section of the chart of accounts is, I'm using a slightly different account title than what I generally use for corporation equity. And I'm trying to follow the terminology used in our text for this sort of account. And so I'm using the account, kind of a generic account name, contributed capital. And that terminology is a little bit of a misnomer. It's a little confusing. Capital is not contributed to a corporation. A corporation basically sells shares of stock, and the amounts paid by stockholders into the corporation are recorded in the equity accounts. So the generic title for this account is contributed capital. Some other probably more commonly used account names for this sort of account would be either common stock or preferred stock. So again, I'm just using this generic account title, contributed capital. This carries a credit balance, and the amount recorded in the contributed capital account is calculated by taking shares issued or sold times the par value of those shares. Now, par value is kind of a vague term. It's kind of hard a concept for students to understand. When a corporation is formed, legally formed with the state in which the corporation is incorporated and will do business, one of the pieces of information about the corporation is the amount of par value for each share of stock. It is an entirely arbitrary amount, and amounts that are commonly used as par value for shares of stock of the corporation would be $1, or $5 or $10, just an arbitrary amount. And so again, the amount recorded as a credit in the contributed capital account is equal to shares issued or sold times the par value per share. Now, is the par value the amount that shares are normally sold for? The answer to that question is no. Shares are issued for some price that is a market price based on market conditions. And of course, you have to understand that we're generally talking about large publicly traded corporations and their stock that is selling on the stock market. So basic economic factors of supply and demand go into the pricing of stock on the free market. And basically the way that works is the lower the supply and the higher the demand for any one stock, the higher the price of that stock will be. And conversely, the higher the supply and the lower the demand for any one stock, the lower the price of that stock will be. So stock prices fluctuate, they can fluctuate daily. And one of the attributes of a good solid business is the stability of its stock price over time. Of course, all corporations would like to see the value of its stock go up over time, and that usually is a sign of a well-run company with good products and services. Okay, anyway, getting back to our accounts. An account closely related to the contributed capital account is an account called contributed capital in excess of par. The amount recorded as a credit in this account is based on shares issued or sold times price minus par. Now, I think it's probably a good idea to show a simple example as to how that would work. Let's say the price of a stock is $100. Price per share, let's say, is $100. And let's say the par value, of that stock is $10. That makes the difference between the price and the par, and let's call that premium. The premium on that share of stock would then be $90. So the way it would work is if we subtracted par from price, the difference would be $90, and let's call that premium. So if a company is issuing or selling 1,000 shares of stock, we would multiply each one of these three amounts by 1,000 shares. So the total amount of cash that the company would be collecting from shareholders would be equal to $100,000. The total par value of that transaction would be $10,000. And the total premium or amount contributed in excess of par on that transaction would be $90,000. So how would we record this transaction? Well, the price, the amount collected by the corporation would be $100,000, and we would debit cash for that amount. The amount of the par value amount of that transaction would be $10,000, par times shares issued, and so this would be the amount recorded in the contributed capital account as a credit. And the difference between the price of 100 and par of 10, which we'll call the premium, the difference is $90. If we were to multiply that price minus par, $90, times 1,000 shares issued, that's $90,000, and so that would be the amount reported as a credit in the contributed capital in excess of par account. And so we would have two credits in each of these two accounts, offset by one debit of $100,000 that we would record in the cash account. And that's an example of a simple stock transaction. Okay, moving on. Let's stick on the left side of this sheet. Treasury stock represents shares of stock that the corporation has previously sold or issued to stockholders and has subsequently repurchased from those stockholders. And so the treasury stock account is kind of a contra equity account. It carries a debit balance. It is a subtraction when we look at equity on the balance sheet. Equity carries a credit balance, so anytime we have a debit balance account, we would subtract that amount. So it reduces the amount of stockholders' equity on the balance sheet. And the amount recorded as a debit in the treasury stock account is calculated by taking the number of shares repurchased times the price that we have paid per share for those shares of stock. Now these three accounts are part of the equity that is generally referred to as contributed capital. Equity that is coming from the owners or coming from the outside of the corporation, coming from individuals or interests that are outside of the corporation. Contributed capital in excess of par, and treasury stock. Over on the right side, we only show two accounts that are that represent internally generated capital. We have the retained earnings account. The retained earnings account is a credit balance account, and basically for a corporation that is earning profits on a regular basis, the main entry into the retained earnings account on a annual basis would be at closing, when we close the income summary account. Keeping in mind, I'm going to put it in real small here. Our income summary account, when we close our accounts, we close revenues to income summary, ends up on the credit side of income summary, and we close expenses to income summary, ends up on the debit side of income summary. And then if we were to take a balance of income summary after our first two closing entries, we would like to see the balance on the credit side of the income summary account. And if the balance is on of this account is on the credit side, that means that revenues are larger than expenses. And so that means our balance represents net income. And so the third step of closing is to close the income summary account with a debit and a corresponding credit to retained earnings. And this corresponding credit to retained earnings is our net income. So that is our pretty much the only entry we have going into retained earnings on a regular basis in a corporation. Of course, if we have a net loss, then this process would show a balance that is different, would show a debit balance in income summary, and when we close that balance in income summary, the net loss would translate to a debit in the retained earnings account. And of course, a debit in the retained earnings account would be a reduction of retained earnings. And then finally, the last account we have up here that we'll talk about is the dividends account. Dividends, like treasury stock, dividends is a debit balance account. It represents a reduction of equity, and dividends really ends up being a reduction of retained earnings. The amount recorded as a debit in the dividends account is equal to the outstanding shares of a corporation multiplied by the amount of dividends paid per share of stock. And again, as I mentioned a minute ago, the dividends account would be closed as the fourth closing entry. Dividends carries a debit balance, so we would close it with a credit and a corresponding debit to the retained earnings account. So those are the main corporate equity accounts that we use in this chapter. And this chapter is, this chapter is another somewhat difficult chapter for the average student. There's a lot of terminology that is new and can be somewhat confusing, and it takes a little bit of time to work through it and gain an understanding of what all this terminology is. But on the other hand, this is chapter 11. After this chapter, there are only 2 more to go, and so we are near the end. And so with that, I'm going to close this lesson, and I'll come back with maybe another lesson working on an exercise in this chapter. Thanks for your attention.